I'm Owen Bigland. This is the Inside Edge video blog. Okay, it's September 2022. Everywhere you look here, as well as for most of the summer here, you pick up the newspaper or the news or watch the 6 o'clock news. It's all doom and gloom, of course, here across the board. The economy, oil prices are going down. The Canadian dollar is at a 2-year low. Canadian real estate is in the midst of an epic crash. The stock markets are crashing. Run for the exit, sell what you have. So the media loves these type of markets because, as you guys know, 85% of the media these days is leaning towards the negative side, that fear, the envy, the high anxiety, getting you to make dumb moves, sell your stock, sell your house, time markets, which is the worst advice, you can get. So they love this kind of thing, and I'd say maybe 10 or 15% is more balanced, or at least maybe a little bit of a ray of optimism. Every now and again, you get a guy who talks some common sense. I hope I'm one of them for you guys as well, to just tell you to stay calm. These are run-of-the-mill corrections. I've been through so many of these over the last 35 years in Vancouver real estate and in the stock market. I lost count. As a matter of fact, just stay the course if you own a home or you've got a stock portfolio, and possibly use these downturns, especially in the stock market, as good buying opportunities. But as you guys know, I get a lot of the media through our media liaison in our office here. So I had a whole pile of it stacked up here when I got home from my summer vacations here. But it's all over the road, and I want to show you this, give you some real life example here from BNN Bloomberg. How the consensus is everywhere from a 50% crash. People are calling for a crash in the stock market and in the real estate market. So a crash meaning, the definition of crash is 50% or more from its peak. Because I see people saying an epic crash is upon us, and then you'll read it and they'll say real estate prices could drop by 15 or 20%. That is not a crash. That is a run-of-the-mill, we get those every 3 or 4 year, market correction. That's hardly a crash. But it's all over the road here. So I'm going to give you a couple of prime examples here and then give you guys my actionable advice here on what to do, which is nothing. Stay the course, keep to your game plan. You've got nothing to worry about here, as one of these articles is going to substantiate. So here are two articles, one day apart, both from BNN Bloomberg. I pulled them off the website. I had these sent to me through my media liaison here. So the big headline on this one, the beginning of it is, TD Bank suggests that an average home prices in Canada could fall between 20 and 25%. So we are in, just starting a major correction. Watch out, folks. 20 to 25% is what this TD Bank report got. So you go on to read a little bit more of it. The forecast in the National Decline of Home Prices would actually only partially retrace the 46% increase we had during COVID nationally. So even if this report they're accurate on this, 20-25%, it will still be 20 to 25% above what home prices were just prior to COVID. That was the rip we had with COVID. And in some cases, homes were up a lot more than 46%. Some were up as much as 60, 70. I see stories in Ontario, where homes were up 70, 80% in the last 2.5 years. Now, they bring in some other guys. The one guy here, the federal forecast would still be well above where it was pre-COVID. We don't really describe this as a correction, but more as a recalibration of the market, which I would agree. If you're up 50 and you drop 20, that's hardly a crash. It's a run-of-the-mill correction that's still ending up well ahead of where it was in COVID. But keep in mind, it could be way more than 20 or 25%. Nothing would surprise me. We could get something more severe if interest rates continue to go up for another 18 months here. Who knows? I've heard people saying that they might have to get the rate up to as high as 6.5%. Anything can happen. Nothing is off the table here. But they also interviewed a couple economists that brought in here, some guy named Sochi here. He says the worst effects will likely be avoided because of several factors. Growing consumer incomes, excess savings, and low inventories. Low inventories is the key here, folks. I do see sales dropping dramatically later this year and into 2023. I think in 2023, the sales volume for the Vancouver Real Estate Board will probably be down 20 or 25%. So that's going to hurt realtors. It's not going to hurt a guy like me, but it will hurt young, unestablished realtors. Probably, as I've often said here, the real estate business is feast and famine. The top 10% of the realtors, Medallion Club qualifiers, are doing 80% of all the sales in the Lower Mainland. The top 2, 3, 4%, like myself, are doing the lion's share of that. It's a feast or famine business. Sales will go down dramatically, and that's what will help perhaps moderate the price drops, because we haven't seen much yet. If interest rates go up, of course it's going to put a cold bucket of water on pricing. But if inventory also stays low, it helps moderate that. So this guy is saying, this economist, maybe something more like about 10 or 12% drop over the next 18 months, not the 20 or 25%. They also bring in, so then they also talk with Canadian Real Estate Association, CREA. They own, they run the real estate boards for Canada. They're the opposite. They are actually, CREA has just come out with their forecast. They're saying that home prices for 2022 will be up about 11%, and they will increase again through 2023 by about another 5%. Well, listen, prices will definitely be up for 2022, because we had some good months in here in the beginning of the year. It's just now that it's starting to cool here since the summer. Probably our numbers for 2022 for the Lower Mainland will probably be up double digits. But we'll see what 2023 brings. CREA is calling for a slight increase over 2023. And I know they have been talking about these interest rate hikes are going to be over sooner than a lot of people think. I've seen some economists coming on some of these news outlets now saying, for sure, we're going to get 2 or 3 more hikes, but don't be surprised by summer or early fall of 2023. They're talking about reducing rates. Again, who knows? The things I'm pointing out here, folks, is it is all over the road here. There is no real consensus, and why I tell you to just ignore most of it. Stick to the game plan. If you own a home right now, enjoy it. If you've owned the home for many years, you're sitting on a ton of it, capital gain. Even if you just bought a house this past year, you've done the right thing. Hopefully you've had good counsel from your realtor, from your banker. You've bought that home. You can keep it for 10, 15 years, grow into it, pay down the mortgage. Interest rates are still incredibly low. You've been stress tested for higher rates anyways. You've made the right decision. And if you're saving for the down payment right now, stick with the game plan. Get that down payment together and buy that home. Who knows? In 2023, you might get a better window. Inventory might start to finally come up a bit. You're not in bidding wars. Good time to be a buyer. So then they also interview a Toronto realtor who sees prices dropping from peak to bottom about 8 to 10%. Yeah. So it's all over the road. It's from a increase of about 5% by CREA to a 25% drop by TD Bank. So it's somewhere in between. And I've seen some that have called for 35% drop. 40% drop I've seen in some of these news articles lately. Again, though, keep it into perspective. Even a 40% drop here would still be higher than what these home prices were pre-COVID. So here's the yin to the yang here. BNN Bloomberg, the next day there's an article, and I gotta give BNN Bloomberg credit. Every now and again they throw out one of these gems that is a little more optimistic. 85% of what they put out is doom and gloom, fear-based. The other 10 or 15% is a little bit more balanced, or maybe even a ray of sunshine, a little bit of ray of hope, some good actionable advice by this guy. So this is put out by one of their main writers, a guy by the name of Dale Jackson. I follow this guy on Twitter. He's very good. He's a financial planner based in Toronto, lots of experience. He has a syndicated column. He writes for BNN Bloomberg. I've seen his stuff before too in the Globe and Mail. He's big on Twitter. He's a meat and potatoes guy. I like this Dale Jackson guy because he just gives good, practical advice to people. And his advice is to stay, same thing I'm telling you guys, stay calm. This is normal. Corrections of 10, 15, 20, 25% are very normal. Markets don't go up in a straight line. Think of it as a recalibration, a resetting. The stock market goes through these every couple of years. I've been through dozens of these over the last 35 years, and way more severe than what we're currently going and even what we even get to here. Remember, I talk about in my book in '08, my portfolio was cut in half, over 50%. And I've been through many real estate corrections here in Vancouver, that are well above 20%. So this is normal. So his article, which came out the day after this one I was just reading you here, is market corrections are part of life. Embrace them. So he goes on to say, that's the bad news. Corrections are part of life and they're normal. The good news is owning a home probably remains the best investment you will ever make over the long term. Agree 100%. How many videos have I done on this? 10, 20? I'll do more later this fall to help people stay the course. Positive affirmation on buying your principal residence and just hanging on to the damn thing. You will do incredible. It'll be the best financial decision you ever made. The biggest reason is the principal residence exemption. It all grows tax-free. You will never going to beat that, ever. Until they take it away from us, which I don't think they ever will, and it'll be grandfathered what you do have if they do, get into home ownership. He says that the estimates for how much home prices will fall over the short term are all over the map. I just gave you guys that previous article. All over the map is right. It depends on factors particular to the kind of residential property and location. And that's for sure. Rural areas, in Manitoba or Saskatchewan or outside these big cities that had these huge spikes, those are going to be a lot harder hit than a one-bedroom condo in Yaletown. Right now, as we speak, there is nothing for sale right now. I've got a whole pile of buyers I'm looking for good quality condos downtown on. Nothing for sale. Prices have not been scathed whatsoever. Stay tuned for some more blogs later this fall. I'll give you some real life examples here. The few listings that are out there are getting into multiple offers still and selling at pretty much record prices still here for the good quality one beds. What is going to get more hurt is the detached market. That's now filtered into a buyer's market, as I told you guys about last month. And the higher end luxury condo market is going to get hurt, and it is getting hurt. Prices are coming down. This Dale Jackson, a long-term, and he kind of stole this, a long-term perspective is the best remedy for short-term fear. I think that's not his original. That's either Bogle or Warren Buffett. But hey, he's welcome to steal a good quote from those guys. Nothing wrong with that. But he went on to say that the S&P 500 is a prime example of how corrections correct because the index holds a diversified cross-section of stocks that reflect the broader markets. Through the close of trading on Thursday, the benchmark has been down about 15% so far year to date. However, the value of the S&P 500 has skyrocketed about 65% over the past 5 years. So again, look at it from a long-term perspective, just like with the housing pre-COVID. Sure, we get a 25% correction. It's normal, and it's still 25 to 30% above what you would have paid for that house 2 years ago. And that's the same thing with the S&P 500, the TSX, the Dow 30, the NASDAQ. He says, corrections work both ways. Now he's quoting an RBC economist here. A housing correction brings opportunity for home buyers, just like equity market corrections bring opportunity for investors to possibly buy below real intrinsic value. Listen, I've been buying earlier this year. I tweet a lot of the stuff that I've been buying back in February and March, and then in June I was double fist buying some incredible bargains here. Now those went up. I had some stuff that was up 25% in about 6-7 weeks that I was buying in early June. I've given back a lot of that now as we speak in September. But listen, I've locked in some incredible yields. These are not 1 or 2 year holds for me. These are 10, 15 year holds for me. These are opportunities for you if you know where to look and can kind of plug your nose at all the doom and gloom and fear that's out there. Here's an idea for homeowners and investors with correction anxiety. Search the long-term price charts from credible online sources. That's super important. Print them out and paste them on your refrigerator. So absolutely, look at the 25, the 30, the 40-year average price graph for Greater Vancouver Real Estate Board. You're going to see, and I post those in my book, Along for the Ride. I talk about the long-term price charts there. The blips along the way are normal. They should be expected. The S&P 500, you can overlay right over that. When you pull back, it's a rocket ride up. When you look closer, you'll see that there are some terrible years in there. I've lived through them with 40, 50% drawdowns. And then I've had years where it's just stayed flat for many years. All I'm getting is the dividends. That's what you sign up for if you want the superior long-term returns. And I love how he points out here, go online for credible online sources. You guys know, I've talked about this many times. There are a whole bunch of sites out there, and they're slowly cracking down on these, that are propaganda sites. They are giving you fake statistics on real estate, especially Vancouver real estate, Toronto real estate. It's made up stats. The only source you want, if you want stats on Vancouver real estate, is from the Greater Vancouver Real Estate Board. Or if you want Fraser Valley, the Fraser Valley Real Estate Board, or the Toronto Real Estate Board. TREB. Those are the only credible sources. Anything else you see, be very careful. It's been massaged, cherry-picked, or just plain made up. It's fictitious. And I know that the boards, Canadian Real Estate Association, Toronto boards, have started cracking down on these sites. Many of them now have been closed down. There's still some out there, but be careful. A lot of fake news out there. I'm going to close just a couple of little quick things here, as I've gone out a little bit here. The great Warren Buffett, I'm always quoting him, and Jack Bogle and Peter Lynch. You know, Buffett, two of his best quotes, I think, here is, the stock market is manic depressive. Always remember that. It's not rational. The real estate markets aren't rational. They will go through exuberance where they're unrational to the upside. The fear of missing out, all that stuff will drive markets up. Be careful of those, but also be careful of panic selling, knee-jerk reactions, listening to the media, selling, doing dumb things. A prime example, which I blogged about, right during COVID, at the beginning of COVID, were all those people that dumped condos at fire sale prices only to watch them go up 150K in about 18 months after they sold. And I've got all kinds of cases of those. I was able to buy a few, would have loved to have bought more. The correction or those knee-jerk selling only lasted about 2 or 3 months, and then it was off to the races again. The other one that I love with Buffett is there seems to be some perverse human characteristic that likes to make easy things difficult. And the media perpetuates this. They watch the financial news on CNBC and Bloomberg, buy this, sell that. They think you have to be doing something to win in the markets, whether that's real estate or the stock market, time markets. And that is the exact opposite of what you want to do. You want to buy high quality assets, good quality real estate, ETFs, low cost ETFs, index invest, and then hang on to it. Keep your friction costs low, keep your taxes low, buying and selling. Let the money compound tax free. It's the only way to go. But people complicate the easy by thinking they have to do something. And of course, they do that because they'll watch a show like CNBC with some guy who thinks he's an expert who he isn't. He's just guessing at things, saying that the market's going to go down 25% in the next 6 months. These guys listen to him, sell, pay the tax man, pay all the capital gains tax, sit in cash, which is losing 7% every year with inflation, and do dumb things and then buy back in. So be careful. My final message here is, if you've been watching my blog here for the last 11 or 12 years, you know that my message never changes. It's the same old story I give you guys, and that is to have a game plan, and that game plan should be to buy quality assets, Vancouver real estate, buy the right homes, buy them comfortably, be able to absorb any interest rate hikes, buy the right property, buy high quality equities or just index invest, and call it a day. Reinvest the dividends. That's all you need to do. Tune out a lot of this stuff. If you really want to watch the media, limit yourself to it. 15, 20 minutes a day maybe if you really want to, but keep in mind it's all entertainment purposes only. Most of the predictions here will be wrong. And of course, the predictions are all over the road, from the market going up next year to the market dropping 25 or 30%. Who knows? Who cares? Stay the course. I don't care. I own a large real estate portfolio. I'm not selling a thing. As a matter of fact, I'm looking to buy some stuff here. And I'm definitely not selling any of my stocks. Whenever I get dry powder, I'm putting more money to work at what I think to be good prices. that I know in 10 or 15 years I'm going to be pretty happy with. I'm Owen Bigland. As always, thanks for watching. I'll see you next week.